If you've ever applied for a business loan and gotten denied, or felt like the lender was asking a million questions about your finances, there's a good chance DSCR may have been part of the conversation. DSCR stands for Debt Service Coverage Ratio. It sounds complicated, but I promise you it's not. And once you understand it, you're going to see your loan application in a completely different way. I work in small business lending, and DSCR comes up on many small business loan applications. Most borrowers have never heard of it. By the end of this video, you will not only know what it is, you'll know how to think about it before you ever walk into a lender's office. So what is DSCR? At its most basic level, DSCR answers one question. Does your business make enough money to pay back this loan? That's it, that's all it is. Lenders use it to measure whether your business generates enough income to cover its debt payments, and they express it as a ratio. Here's the simplest way to think about it. If your business has $110 available to pay debt and your total debt payments are $100, your DSCR is 1.1. That means for every dollar your business owes in debt payments, it has $1.10 available to cover it. A DSCR above 1.0 means your business is generating more than enough to cover its debt. A DSCR below 1.0 means your business isn't making enough to cover what it owes, and that's a concern for lenders. Every lender is different in terms of what they want to see. But generally speaking, the higher your DSCR, the stronger your application looks. Why does this matter for your loan application? Because no matter how great your business idea is, no matter how long you've been in business or how good your credit is, if your DSCR doesn't work, the loan may be harder to approve because lenders rely heavily on the math. This can be one of the reasons businesses get denied that borrowers don't always realize. The borrower thinks everything looks good, decent credit, solid revenue, but their debt payments are too high relative to their income and the DSCR falls short. Here's something really important. Your DSCR is only as accurate as the debt you include. That means everything your business owes needs to be on the table. Loans, lines of credit, business credit cards, equipment financing, anything with a monthly payment. If you leave something out, your DSCR looks better than it actually is. And lenders may catch that when they pull credit or review your documents. So be upfront and include everything. Lenders will typically ask for a debt schedule, which is basically a list of everything your business owes, who you owe it to, the balance, the monthly payment, and the terms. We're going to do a whole separate video on debt schedules because there's a lot to cover there, but for now just know that an accurate debt schedule is what makes your DSCR calculation reliable. So what can you do with this information right now? Before you apply for your next business loan, do a quick back-of-the-napkin DSCR check on yourself. For a simple back-of-the-napkin estimate, start with your annual net income. Then divide that by your total annual debt payments. Here's the formula to remember. Net income divided by total annual debt payments equals your DSCR. This won't be the exact calculation every lender uses, but it gives you a conservative starting point to understand whether your business may have enough income to cover its debt. If your DSCR looks strong using net income alone, that's usually a good sign. If it looks low, it doesn't automatically mean you're out, but it does mean the lender may have more questions. In the next video, we're going to talk about UCC filings, what they are, why lenders file them, and what it means for your business when a lender wants to be in first position. It's one of those topics that sounds intimidating, but once you understand it, everything makes a lot more sense. Subscribe so you don't miss it and drop any questions in the comments. I read every comment, and I'll see you in the next video. And before you go, quick reminder that everything on this channel is for educational purposes only. I'm sharing general information from my experience in small business lending, but this is not financial, legal, tax, or lending advice. I'm not speaking on behalf of any specific lender or employer. Every business, lender, loan type, and situation is different, so always work with a qualified professional for your specific needs.